Good afternoon, and welcome to the Accendo Traders Group. This is our weekend wrap-up report for June 8th, 2008. AccendoTraders.com, effective trade plans delivered daily. And as we go through our routine, we change it up a little bit on the weekends. Our primary goal here with our routine is to make sure that we're aware of what's coming down the pipe as far as market-making news, market-moving events that could affect our trades, and you also want to get a gauge as to where the market is trending up or down or not at all. And as always, we want to scan for new trades, we want to set our alerts, and make sure we have time to spend with our families. So this week, we've got the markets ending down. Obviously, we know that a large percent of that is due to Friday, and we'll talk about that shortly. But again, I do want to point out that the NASDAQ has, for the second week in a row, or more importantly, this is the first clear week of this year. So June in 2008, this is the first week that the NASDAQ is down less percentage-wise for the year than the Dow and the S&P 500. Again, we've been talking for a couple of weeks, really a month, that the NASDAQ has been leading the market. And so the NASDAQ was down not much more, but it was down more than the other two. But since the NASDAQ, the tech sector has been rallying, it's taken over with regards to how far it's been down for the year. Again, we'll talk more about what happened on Friday shortly. But first, we can talk about the financial sector and how it controlled the headlines for the beginning of the week. First, we had Wachovia forcing its CEO to resign, and then Wall Street Journal talking about investigations for AIG, for accounting. Lehman Brothers was in the market for news concerns over whether or not it's going to have its first quarter loss and whether or not it's raising money or had it used the Fed window. And then on Thursday, we had the S&P cut its financial strength ratings on some of the bond issuers. And the funny thing about that is that the market was still going up through all of this. The market was still going up through all of that. Not much. A little light on the volume, but the market was going up. And then we had the same store sales report come out, and Walmart really jumped big on this. And so again, we had, Wednesday, Thursday, the market was moving up. But then came Friday, and Friday we had the employment report. We failed to meet market expectation. We had a decline in an non-farm payroll, which wasn't a big deal. The big thing was that the unemployment rate jumped 5%. 0.5% from, it's now 5.5% from 5%. And, that's the large jump, I believe they said, I can't remember how long, but it's a huge jump, a large jump, I believe, since the 70s or the 80s. And also, not listed in here was some of the mortgage bankers released some reports about the foreclosures. And so there's definitely some concern about the housing market. Crude also on Friday surged 8.4%. To $138, driven by the weaker dollar and geopolitical concerns. Remember, I forget if it was Morgan Stanley or Lehman Brothers. One of the analysts said we're heading to $150. Some say if we're okay if we stay, as long as we stay below it. But I know gas is crazy. We all know that. So this week we got pending home sales. We're a little light. There'll be some look at the Fed Facebook, although we know that the Fed's really not going to be cutting rates anytime soon. There's still being interest there. Of course, some information here in the Michigan Sentiment, the preliminary report is coming out on Friday. So for tomorrow, we've got pending home sales. Nothing really big on the earnings front. I do want to point out, as we talked about, Lehman Brothers has their earnings report before the market opened on Thursday. So I'm sure that's going to be maybe one of the big events for this week. Obviously, we're also going to be looking to see how the consumer is going to be playing out this week. Here's our split plays. Let's go ahead and take a look at our sectors. Okay, and as we begin to look at our sectors, the story of the week, especially obviously because of Friday's move, is that we really have a lot of indecision going out there. We got basic materials. This looks great, but look at that wick. Look at that wick. A lot of indecision there. So basic materials, by definition, last week when we were looking at it, when it retraced down here to the 20, we said by definition it's bullish. And obviously today, we're looking at Friday's move. We still say it's bullish. Certainly want to be concerned about a double top, but basic material is definitely looking bullish. Utilities, still in the blondness. No. Builders, definitely looking weak, so they're going on the bear side. Casinos, the one thing I want to look at is, and you know, we've been talking about the past couple weeks that sometimes I get some bad ticks here, but you can see that they broke a key resistance support level. So casinos are going to be on the bear side, but they've been there. Coal has been bullish, so we're going to keep it there on the bullish side. We'd like to see a break up here. Banks, look at that. Look at that. So banks are definitely on our bear side, so we want to look for trades in that sector going down. You can see the consolidation here in the biotechs, but it's interesting though to see that you know, it really rallied with as the week proceeded along and fell back hard with the rest of the market. But we have this consolidation that we're trying to break out of. But I would put biotechs in the middle range there, in the middle. Pharmaceuticals, definitely. We broke this key support level that we've been talking about, so they're in the bear side. Internets, for the first time, I'm really not going to say which way. They're going in the middle for me. I think by definition, they're still bullish. We've got the 20, bounce off the 20, bounce off the 20, bounce off the 20, bounce off the 20 here, bounce off the 20 here. So certainly we'd like to see that happen again to remain bullish about the internet sector. Gold, kind of blah. We'll see what happens there. Software, still by definition bullish, so I like there. Insurance, broke this key support level, bearish. Oil services, kind of, you know, waffling, kind of consolidating, so, but by definition, we'll go with bullish. Retails, this is that key support level that is coming back down again. If it breaks there, definitely bearish. Stocks is kind of consolidating, by definition bullish, but not blowing me away. Brokers, kind of in a blah level. I'm not brokers, transports. Here's the brokers at a key support level 161. If we break this, definitely bearish. Natural gas, you know, still kind of blush. And oil. So again, what we have on the bullish side is basic materials, coal, software, a little bit internet, a little bit software. On the bearish side, we have builders, casinos, banks, drugs, insurance, and possibly retail and brokers if they break their key support levels. Okay, and as we begin the education portion of our video, we're using the book Trading the Zone by Mark Douglas. We're in the second chapter, The Lore of Trading, and the addiction to random rewards. And I'm not going to read the whole thing here. It's actually a very short section, just really a page. And just want to really go down to the bottom here, where it says, basically, when we do something, expecting a reward, expecting to be, you know, a positive result, and we get the same disappointing outcome, that it's likely that we will. It is not likely that we will keep doing the same thing that causes us this emotional pain. Meaning, when we when we go to make a trade and it doesn't work out for us, either we lose money or we get whipsawed out of the trade or whatever. And we don't get that that positive result, then we begin to stray away from that activity. And again, what I'm looking at here is that people start to either stop trading or what do they do? Well, this didn't work, so now I'm going to go try the Qs. Oh, the Qs didn't work, so now I'm going to try Forex. Oh, the Forex didn't work, so now I'm going to go try spreads. Oh, that didn't work. So, you know, you keep changing from system to system, to routine to routine, to style, and you know, the first time you get a negative result, you know, you're trying to avoid that negative result, and so you move on to the next thing. So, for traders, this is troublesome because it's another source of resistance to creating the kind of mental structure that produces consistency. Again, the key to all of this is that it's not that a trade plan means that we're going to always be profitable. It is that a trade plan means that you've taken the time to train yourself, to give yourself the mental structure to know that I'm going to take advantage of the opportunities that I believe are successful, and there's no guarantee that it's always going to be successful, and I'll make adjustments as needed, but I'm going to consistently look for these type of patterns, these type of signals, and be consistent as to who I am. That's one thing that I've been saying, you guys know from the beginning. Be you. Be who you are. If this is who you are, be that. When you jump from system to system, you're just setting yourself up for failure. So there it is. You know, to get the full Weekend Rapid Report podcast, there's the link As always, we continue to appreciate the feedback that we receive. And certainly go check out my blog at michaelglass.com. Let's get that discussion going. Let me hear what you guys have to say. Talk about some changes you might want to see. Talk about some patterns that we want to study. That's coming starting next week in the videos. We're going to start talking about chart patterns and stuff like that. So as always, to your own risk, and I will see you guys tomorrow.